Stop what you are doing right now because while you were enjoying your weekend, while you were spending time with family, while you were going about your normal Saturday routine, the world fundamentally changed in ways that will affect your wealth for years to come. And if you do not understand what happened in the last 48 hours, you risk being completely blindsided when markets open Monday morning. Let me tell you what we are dealing with. Gold just closed at $5,230 per ounce. That is not a typo. That is not a projection. That is where gold is trading right now. And here is the number that should stop you in your tracks. 1 year ago, gold was trading at $2,841. Do the math with me. That is a 72.93% gain in 12 months. If you had put $100,000 into gold 1 year ago, you would now have $172,930. Meanwhile, the S&P 500 just posted its worst month since March 2025, and the Nasdaq is bleeding on AI valuation fears. But that is not even the headline. The headline is what happened Saturday. The United States and Israel launched coordinated military strikes against Iran. Iran retaliated with missiles across 4 Gulf nations, the Strait of Hormuz, the narrow waterway through which 20% of the world's crude oil and 23% of global LNG flows every single day, reportedly closed. And the already powerful bull case for gold just received the single largest geopolitical catalyst since Russia invaded Ukraine in 2022. This is not just another news cycle. This is the kind of event that reshapes markets for a generation. And when trading resumes Monday, precious metals are positioned for a gap up that could leave unprepared investors behind forever. Before I break down exactly what this means, what institutional analysts are saying, and how you should be thinking about your positions, I need you to do something for me. Look at that subscribe button right now. If you have been watching these videos, if you have been getting value from this analysis and you still have not subscribed, now is the moment. We are building something special here at Mr. AG Asian Guy, a community of informed investors who understand what is really happening in global markets. Your subscription matters more than you think. Also, drop a comment right now and tell me where you are watching from. Are you in the United States, India, Canada, Australia, the United Kingdom, Singapore, Malaysia, Hong Kong, the Philippines, Japan, somewhere in Europe or the Middle East? I want to know because this community spans the entire globe, and understanding where you are helps me deliver content that matters to you. All right, let us dive into what just happened and why Monday could be unlike anything we have seen in years. First, let me give you the gold numbers, because they are extraordinary. 7 consecutive monthly gains. 7 months in a row where gold has posted positive returns. The last time gold went sideways for a month was August 2025. Since then, it has been relentless. February alone delivered a 7.6% monthly gain, and the year-over-year performance, 72.93%. That is the kind of return that changes financial plans. That is the kind of return that shifts generational wealth. Think about what this means in context. From 1971 to 2024, traditional stocks averaged 10.7% annual returns, while gold averaged 7.9%. The historical argument against gold was always that stocks outperform over the long run. But that gap narrowed dramatically in 2025 and has now fully inverted in 2026. Gold is crushing equities. The inversion is not an accident. It is the predictable consequence of an environment where inflation runs above central bank targets, where real yields are declining, where geopolitical risk is rising, and where equity valuations that were stretched by passive flows are now unwinding. And then Saturday happened. The U.S.-Israeli joint military operations with code names like Epic Fury and Roaring Lion, targeted Iran directly. The strikes hit Tehran. The response was immediate. Iran retaliated with missiles across 4 Gulf nations, and most critically, the Strait of Hormuz faced closure. Let me explain why the Strait of Hormuz matters so much, because most people do not fully grasp the significance. This narrow waterway, approximately 21 miles wide at its narrowest point, carries roughly 1/5 of the world's crude oil every single day. It also handles 23% of global liquefied natural gas shipments. When Iran restricts or closes this passage, they are not making a political statement. They are squeezing the jugular vein of the global energy market. Multiple major oil companies and trading firms have already put shipments on hold at the choke point. Brent crude was hovering near $73 per barrel on Friday. But Capital Economics' William Jackson noted that a move to $80 would revisit last June's highs, and sustained disruption could drive Brent to $100 per barrel. $100 oil, let that sink in. That is not just a number. That is an inflation event. According to analysts, a move to $100 oil would add 20 to 30 basis points to headline CPI. That would eliminate any remaining window for Federal Reserve rate cuts in 2026, and every dollar that oil rises feeds directly into inflation expectations. Here is the connection that matters for your portfolio. Rising inflation expectations are the single most consistent driver of gold demand in the modern era. When people fear that their purchasing power is being eroded, when they see energy costs spiking and grocery bills rising, they reach for the asset that has preserved value for 5,000 years. They reach for gold. This is why the Iran strikes are not just a geopolitical story. They are a gold story. They are a silver story. They are a precious metal story that could define the trajectory of prices for months or even years to come. Quick question for the comments. When you heard about the Iran strikes this weekend, what was your first thought? Did you think about your precious metals position? Did you think about whether you should have bought more? Did you feel relief that you were already positioned or regret that you had not acted sooner? I want to know how this community is processing these historic events. Now let me tell you what institutional analysts are saying, because this is where it gets really interesting. The commentary coming out of major desks is not subtle. They are explicitly warning about what Monday could bring. OCBC's Christopher Wong warned that safe haven assets like gold are likely to see an upside gap when trading resumes, not might see, likely to see. That is an institutional analyst putting his reputation on the line with a directional call. Mizuho's Vishnu Varathan went even further, flagging a potential 10 to 25% premium in oil prices if the turmoil widens. Think about what that means. If oil jumps 10 to 25%, the inflation transmission into gold demand becomes immediate and powerful. Blue Line Futures chief market strategist Philip Streibel identified $5,450 as the next upside target for gold. That is 4.2% above Friday's close, a move that could happen in a single gap-up session Monday morning if the Iran headlines remain unresolved. He also identified $5,120 as support, the level where buyers have consistently stepped in during the past 4 weeks. So the range that professionals are watching is 5,120 on the downside and 5,450 on the upside. If de-escalation headlines emerge before the Asia Open, the weekend risk premium could partially evaporate, and gold gives back to support before finding a bid. If the conflict broadens, 5,450 falls within hours. But here's the thing. 5,450 is not the end of the road. Not even close. The technical structure and fundamental backdrop are pointing to something much larger. Let me talk about the $6,000 target, because this number is appearing more frequently in serious analysis. The gold-to-S&P 500 ratio, which measures how many units of the S&P 500 you can buy with 1 ounce of gold, just broke out of a triple bottom pattern. For technical analysts, a triple bottom breakout is one of the most reliable bullish signals in the pattern recognition playbook. The target of this breakout points to a ratio of 1.26. To reach that ratio from current levels, either the S&P 500 needs to fall dramatically, or gold needs to rise dramatically, or both. Given the current environment with equities under pressure from AI valuation concerns and precious metals supported by every fundamental driver you can name, the more likely resolution is gold rising towards $6,000. $6,000 gold. That is another 14.7% upside from current levels, on top of the 72% gains already achieved in the past 12 months. This is not a normal market. This is a structural bull market in precious metals that is still accelerating. Now let me talk about silver, because silver is doing something even more explosive than gold. And if you understand why, you can position yourself for potentially life-changing gains. Silver just surged nearly 8% in a single session, pushing into the $93 to $94 range. While gold was up about 2% in response to the Iran strikes, silver was up 8%. That is a 4-to-1 outperformance, and this ratio tells you something crucial about how the market is viewing silver. Silver is acting as what analysts call a high beta safe haven. It amplifies the fear trade. It moves faster and harder than gold during crisis periods. And right now, with the silver squeeze of 2026 entering what analysts are calling a parabolic phase, the setup for silver is arguably even more compelling than the setup for gold. But there is something happening in the silver market that most coverage completely ignores, and understanding it could be the difference between making money and getting destroyed. There is a critical liquidity trap developing in the COMEX market. Recent reports indicate that a sell order of 159 million ounces triggered a trading halt on the CME. Let me explain why that matters. The registered inventory available for delivery on the COMEX is under 60 million ounces. The sell order was more than 2.5 times the amount of silver actually available. This is the paper versus physical disconnect that sophisticated investors have been warning about for years. The paper market can create the illusion of unlimited supply. Contracts can be written, positions can be established, prices can be pushed around. But when it comes time to actually deliver metal, the reality is very different. With March 1st notice day approaching, the day when futures contracts can be converted into delivery demands, the physical silver market is tighter than at any point since the 1970s. Let me repeat that. Tighter than at any point in over 50 years, and major banks are responding. Deutsche Bank recently signaled that the current gold-to-silver ratio of 57 presents significant upside risk to their $100 per ounce forecast for silver. Eric Sprott, the billionaire precious metals investor, has warned that if the physical supply drain continues, a revaluation shock could eventually target $300 silver, triple-digit silver, potentially $300 silver. These are not numbers being thrown around by random commentators on the internet. These are numbers from Deutsche Bank and billionaire investors who have made their fortunes understanding these markets. For those of you watching from Asia specifically, I want to highlight something that is not getting enough attention in Western coverage. The premiums being paid for silver in Asian markets have remained elevated, even as Western paper prices fluctuate. Chinese investment funds are trading at such significant premiums to net asset value that some have had to halt trading to protect investors. What does this tell you? It tells you that demand for silver in Asia is so intense that investors are willing to pay substantially more than the official price just to get exposure. That kind of premium persistence is a signal of genuine physical tightness, not paper market games. Let me ask you a question. How many of you understand the difference between paper silver and physical silver? Do you know whether your silver exposure is backed by actual metal sitting in a vault, or whether it is a contract that promises metal but might not be able to deliver? Drop your thoughts in the comments, because this distinction could determine whether you benefit from what is coming or whether you end up holding an empty promise. Now let me talk about something that almost no one is discussing, but that represents a fundamental shift in how precious metals markets operate. Tokenized gold. As of right now, tokenized gold assets like PAX-G and XAUT are trading at $5,358 and $5,295 respectively. These are slight premiums to spot gold, and they reflect something important. During weekends, when traditional markets are closed, tokenized gold runs 100% of price discovery. Think about what this means. While COMEX is closed, while the London market is closed, while traditional futures are not trading, the cryptocurrency markets are open 24/7, and the tokenized gold trading on those markets is setting the real-time price. This weekend, with the Iran strikes unfolding, anyone watching tokenized gold could see in real time how the market was digesting the news. The premiums built into PAX-G and XAUT are the market's best estimate of where spot gold will open Monday morning. And those premiums suggest a gap up is coming. This is a structural change in how precious metals markets work. The 24/7 accessibility of crypto-native gold exposure means that weekend news events get priced in real time rather than waiting for Monday's open. If you are not paying attention to tokenized gold markets, you are missing a crucial source of information about what is coming. For those of you watching from different time zones, this raises an important question. How are you planning to handle the Monday open? Are you in a region where markets open while you are sleeping? Are you setting alerts? Are you placing limit orders in advance? Are you planning to stay up and watch the Asia Open regardless of what time it is? Tell me in the comments how you are approaching this, because the collective wisdom of this community is valuable. Now let me talk about the oil-gold transmission mechanism, because this is where the Iran situation connects directly to your portfolio. Here is how it works. Geopolitical disruption threatens oil supply. Oil prices spike. Higher oil prices feed into transportation costs, manufacturing costs, food costs, everything. Inflation expectations rise. Central banks lose the ability to cut rates. Real yields fall or stay negative. And all of that drives money into gold as a hedge against purchasing power destruction. This is not speculation. This is history repeating itself. Every major oil shock in the past 50 years has been accompanied by rising gold prices. The 1970s oil crisis, the Gulf War spike, the 2008 run-up. The pattern is consistent and it is logical. Right now, we are potentially looking at the most significant oil supply disruption since the 1970s. 1/5 of global oil flows through a waterway that is reportedly closed. Major trading firms are holding shipments, and Iran has demonstrated its willingness to escalate across multiple countries simultaneously. If oil goes to $100, gold goes higher. It is that simple. The transmission mechanism is direct and it is powerful. Now I want to give you a reality check because I know some of you are thinking this all sounds too bullish, too one-sided, too good to be true. And you are right to be skeptical. Markets do not move in straight lines. Even in the strongest bull markets, there are corrections. There are shakeouts. There are moments where everyone questions whether the trend is over. Gold could pull back to $5,120 if de-escalation headlines emerge. Silver could fill its gap and drop back toward $91. The fear premium that built up over the weekend could partially evaporate if diplomacy makes progress. If you are trading rather than investing, you need to be prepared for both scenarios. You need to have stops in place. You need to size your positions appropriately. You need to accept that being right about the direction does not guarantee being right about the timing. But here is what I want you to understand. Even if there is a short-term pullback, the structural bull market in precious metals remains intact. The forces driving gold higher, persistent inflation, geopolitical instability, central bank buying, declining real yields, the gold-to-equity rotation, these forces do not disappear with one diplomatic phone call. The investors who win in these markets are not the ones who try to time every wiggle. They are the ones who understand the bigger picture, who position appropriately, who buy weakness rather than chase strength, and who have the conviction to hold through volatility. Let me ask you this. If gold pulls back 5% this week, will you panic and sell, or will you see it as an opportunity to add to your position? Your answer to that question determines whether you are an investor or a tourist in this market. And the tourists are the ones who end up donating their positions to the professionals. Now, let me talk about the mistake that destroys people in precious metals bull markets. And I have seen this mistake wipe out investors who were completely right about the direction. The mistake is leverage. When gold is up 72% in a year, when silver is surging 8% in a day, the temptation to use leverage becomes almost irresistible. Why own 10 ounces when you can control 100? Why settle for normal gains when you can multiply them? Here is why not. Because gold can drop 5% in a single session. Because silver can drop 15% in a week and then recover to new highs. Because exchanges can raise margin requirements overnight, turning a comfortable position into an emergency margin call. Because volatility does not respect your thesis or your conviction. The people who get destroyed in bull markets are not the people who are wrong about the direction. They are the people who are right about the direction, but wrong about the risk management. They use leverage. They get shaken out at the worst moment. They watch the move they predicted happen without them. I have seen this pattern repeat so many times that I can almost predict it. Silver surges. Someone buys on leverage at the high. Silver pulls back 20%. Margin call hits. Position liquidated. Silver recovers and makes new highs. The person is left with nothing. Do not be that person. Own precious metals in a size you can hold through a 30% drawdown without panicking. That is the position size that lets you actually benefit from the bull market you believe in. Speaking of positioning, let me give you a practical framework for thinking about the current setup. If you are already positioned in gold and silver, the question is whether to add. The answer depends on your current allocation and your conviction level. If you are underweight relative to where you want to be, pullbacks to support levels are opportunities to add. If you are already at your target weight, sitting tight and letting the position work is probably the right move. If you are not positioned and want to get in, the question is how to enter without chasing. The answer is to wait for pullbacks rather than buying gap ups. Monday might open significantly higher. That is not the time to establish a new position. Wait for the market to consolidate, to pull back to support to give you a better entry. Patience is rewarded in these markets. If you are uncertain about the thesis altogether, the answer is to size small enough that you can tolerate being wrong. A small position lets you participate in the upside while limiting your downside. You can always add more as your conviction grows. The one thing you should not do is sit completely on the sidelines while the structural bull market continues. The worst outcome is watching gold go to $6,000 and silver go to $150 while you wait for a pullback that never comes. Some exposure, even if small, ensures you participate in the trend. Now let me give you the specific levels I am watching. For gold, the immediate support is $5,120. That is where buyers have stepped in repeatedly over the past month. If gold pulls back to this level and holds, it is a buying opportunity. If it breaks below with conviction, the next support is around $5,000. The immediate resistance is $5,450. That is the target the professional analysts are watching. A break above this level with volume opens the path to 5,700 and eventually 6,000. For silver, the support is $91.33. As long as silver holds above this level on a daily closing basis, the parabolic trend remains intact. A break below this level would require reassessment. The immediate resistance is $95, the final psychological barrier before triple digits. A clean break above 95 opens the path to $104 as the next structural objective. These are the levels where the battle will be fought. Watch them closely. Before I wrap up, make sure you are connected with us beyond just these videos. Join our WhatsApp community using the link in the description. That is where we share real-time updates when markets are moving fast, additional analysis that does not always make it into videos, and where we have conversations with members of this community about what we are seeing. Also follow us on X, that is Twitter, at Mr. AG Asian Guy. We post updates throughout the day when significant moves happen or when important news breaks. Let me leave you with the big picture as we head into what could be one of the most significant weeks for precious metals in modern history. Gold has risen 72% in 12 months. Silver has risen over 170% in the same period. 7 consecutive monthly gains for gold, 10 consecutive monthly gains for silver. And now the biggest geopolitical catalyst since Russia invaded Ukraine has been added to an already bullish setup. The structural forces driving this bull market, persistent inflation, geopolitical instability, central bank buying, equity market rotation, declining real yields, none of these are going away. If anything, they are intensifying. $6,000 gold is not a fantasy. It is a target that serious analysts are discussing based on technical breakouts and fundamental drivers. $100 silver is not a meme. It is a level that major banks are putting into their official forecasts. $300 silver is not impossible. It is what happens if the physical supply drain continues and the paper market disconnect resolves violently. But I want to end with a warning. Nothing in markets is guaranteed. The setup can be perfect and the trade can still go wrong. Geopolitical tensions can de-escalate faster than expected. Central banks can surprise with hawkish pivots. The dollar can strengthen and pressure metals. The investors who succeed are not the ones who predict every move correctly. They are the ones who have a plan, who manage risk appropriately, who size positions correctly, and who do not let emotions drive decisions. So ask yourself honestly as you head into Monday, do you have a plan? Have you decided what you will do if gold gaps up 5%? Have you decided what you will do if gold gaps down 5%? Are you sized appropriately for the volatility that is coming? Can you hold through a pullback without panicking? If you can answer yes to those questions, you are better prepared than most market participants. And that preparation is what will determine whether this historic moment builds your wealth or breaks your conviction. Drop a comment answering this question. Where do you think gold will be trading by the end of 2026? 5,500, 6,000, higher? And tell me where you are watching from. I want to see just how global this community really is. If you have already made money in this precious metals bull market, share your story in the comments. Even a short note about when you bought and how you have handled the volatility helps inspire others who are still building their positions. Let us create a community where we celebrate wins, learn from each other, and grow together. The world changed this weekend. The Strait of Hormuz is closed. Missiles are flying across the Middle East. Oil is poised to spike. Inflation fears are rising. And gold and silver are responding exactly the way they have responded to every major crisis in human history, by going up. The question is not whether precious metals will be higher in the years ahead. The question is whether you will be positioned to benefit. Stay focused. Stay disciplined. Make decisions based on strategy, not emotion. And I will see you in the next video with updates on how Monday unfolds and what it means for everything that comes next.